Hello and welcome to Pro Trader Strategies Market Commentary for Tuesday, November the 1st. My name is Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal, where I've commented on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these daily market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies that you can implement into your own portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters, I don't know what's in your portfolios, and therefore what I'm doing could be counterintuitive to what you are already doing. Having that out of the way, let's get this on. Not a whole lot of economic data today. Actually, it's a French and Italian bank holiday, so we could see slightly lower volumes due to that. Over across the pond, we also got the the Great Britain manufacturing PMI came right in line with expectation, and we also had the Swiss manufacturing PMI come in line with expectations. Here in the United States, we got the final manufacturing PMI come in right in line with expectations at 53.4, and we got the ISM manufacturing PMI, which is the more important of all of the PMI numbers that I've been talking about because it is released by the Institute for Supply Management, right in line with expectations at 51.9. We also had construction spending see a big pullback. Was expected to be a positive 0.5%, came in at negative 0.4%, so a big pullback there. And then we had Institute for Supply Management coming in line for their prices paid with expectations at 54.5. We had TIP Economic Business Optimism come in better than expected, above 50 at 51.4. It was expected to be 48.7. So pretty decent numbers coming out aside from that construction spending number. But the overall markets are reacting to the downside, other than with crude oil and say maybe gold. But crude oil /CL holding its own, up 9 cents after yesterday's big sell-off. Once we got below that 61.8 Fibonacci level, the market really kind of just fell out of bed, but trading well under $50 a barrel, so it just never could make it back above there once we got below that $50 a barrel, and the overall markets are coming off. There's a lot of oil out there. They keep increasing rig counts. Iran is not going to come to the table. That just bodes well for the bears in the oil markets. On to gold. Gold's reacting because the overall equities are down. We're having gold up about $14 on the day. I did test the 200-day moving average early on this morning and has since kind of taken a breather away from there, but is looking to test that area. And keep in mind that $1,300 mark psychological level just above that 200-day moving average. Onto the bonds. Bonds are down on the day as well, down 0.5 point. Was pretty much stuck in line, going sideways. You know, I thought it was looking like it was going to pretty much stay right here at the value area. This is a pretty big value area node for the most part, so it could be off just a little bit and be very happy there. But something to note, we're getting very close to this cross with the 200-day moving average and the 50-day moving average, so keep that on your watch list. Into the Dow Jones Industrial Average, down 34 points on the day, almost 35, and just stuck in this trend sideways for the past month or two for the most part. So overall equities, just nothing to see here and moving sideways. Pretty boring for the most part. Then the NASDAQ down just over about 12 points on the day for the most part. Again, though, you know, this is the range that the NASDAQ has seen, and it seems to be very comfortable with that. Keep in mind that I talked about the value area high and the point of control being very close in proximity. It'd be interesting to see if they can get away from that. The VIX is starting to creep up which is an indication of people getting a little bit nervous to the downside. So that's something to keep in mind. But again, with the E-mini S&Ps still stuck in this range, no, I mean, nothing to see here. It's not going anywhere until we get outside of that range, really. And then the breakdown of the E-mini S&Ps on a 15-minute chart, as you can see, when the economic data started coming out, that's when the overall market came down. It could be retaliation for better than expected numbers, or decent numbers, I should say, coming from the ISM manufacturing PMI, and the market may be getting a little nervous about the increase in interest rates on the horizon. So something to keep in mind there, that the markets could start throwing a tantrum if there's more hawkish sentiment on the overall economy. Hawkish means that they would increase interest rates. So dovish is when they look to hold off or pull back on interest rates. So there would be acting a little more hawkish if they thought inflation was around the corner, and if they thought that the market needed another increase in interest rates. The only trade that I've done today is in Honeywell, and Honeywell has some pretty decent implied volatility. It's above 50. It's one of the few ones that do. So I decided to go into December and do the 100, 115 strangle. So the 100 calls and the 100 puts, and then the 115 calls, and collected $1.35 for it. It's actually skewed to the downside. When I did this trade, it was trading right around 109 where it is now, and the overall market is skewed to the downside. So I was able to get $9 to the downside to get those 100 puts, and only about $6 to the upside to get those 115 calls, and I collected 78 cents for the puts and only 57 cents for the calls. So a lot of skew going on there, and people looking to the downside to protect their position to the downside in Honeywell. All right, so that's all I've done for today. Friday's webinar is going to be on long straddles, and it's going to be for a big move. So if the market's really setting up for a big move, this would be a good time to put that in, because there's a lot of low implied volatility, and that will really do nicely in a volatile or an increasing volatile market and a big move in either direction of the underlying. All right, so check that out. Go to protraderstrategies.com, sign up for that. If you can't take that, take it easy.